Welcome, everybody. We're here today at the Optimising the New Financial Year live panel event. We're really looking to get the insights from a leading private lender, non-bank lender, and commercial lender about the secrets to writing more and better commercial finance deals. So in this session, we're going to look at how to quickly identify what type of finance an SME requires, how to really understand your customer, and off the back of that, how in turn you lock down a customer, moving the conversation beyond rate to terms, which is such an important area, particularly in the current environment that we're in at the moment. In that, we'll also be fleshing out how to work out if a deal should actually progress to a lender, and equally from a lender's perspective, how to expedite a decision for funding and the likelihood of success for that deal being funded. In that, we're going to really drill down into what is a hypothetical deal versus a real deal. So again, to help you optimize your efficiencies. And off the back of that, as Matt has said, we've got some great people on our panel. Matt, obviously from Aquamore Private Lender, Shan from Latrobe, and Peter Nicolo, who is from Peak Capital, and he specializes in commercial finance. So throughout this session, we really encourage you to feed any questions through. We want to make it as engaging as possible. So if you use a Q&A function, or equally the chat function, I will then feed those questions through to the panel throughout the event, or perhaps at the end of the event in the Q&A time. So let's kick off. So Matt, I'm going to go back to you, stealing your job from the moderator and putting you back on panel. So let's kick off by having a quick recap about the alternative finance sector at the moment. There's a lot going on in commercial finance. So just at a very macro level, Matt, can you just let us know a bit of your observations about what the state of the market is at the moment?
Yeah, look, as you said, it's a very interesting time in the, I'll say, alternative finance market, in the private lending market, and sort of non-banking second tier. It's certainly increased. The volumes are ramping up over the past 3 to 4 to 6 months. I think that's on the back of rising interest rates, which has started to squeeze the lack of available credit. The banks and the major lenders, their appetites are starting to be reined in a little bit as well. Obviously, in a higher interest rate environment, we're getting higher up the risk curve as well. So the major lenders aren't loaning as much money. Peer-to-peer platforms and investors, for example, they're starting to shy away a bit as well. And there's, as I said, a real lack of available credit, and that's starting to really show itself. So yeah, things are getting very busy in this space. You're on mute.
Okay, so yeah, there's definitely a lot happening at the moment, that's for sure. So taking this on board, let's focus on how to optimize the new financial year and how to be proactive in this space. So I know, Peter, from your perspective, this is very much about asking the right questions and having strong conversations that boost borrowing. So Peter, over to you. What would your tips be about how to quickly identify what type of finance an SME requires?
Okay, so in order to identify what type of finance an SME requires, so if you're like a resi broker, you need to understand what, products and services you offer. Are you offering cash flow loans, asset finance, property debt? So obviously you're doing home loans, but you're trying to identify other opportunities to help your client. So once you are comfortable with those other loans that you can offer a client, then you ask questions around those loans. So you want to tailor the questions, around the property questions. Are you planning on buying or selling a property in the next 12 months? If they say yes, is it residential? Is it commercial? If they're selling a property, they might be selling because they want to buy another property, or they're looking to expand and just buy another property. And then another question, you can ask is, do you have any planned capital expenditure? Are you going to be buying any cars, any utes, trucks? Are you going to do a fit out for your business? Are you going to buy some machinery? So that's trying to uncover and identify another borrowing need. If they might be importing some goods. Another question is, do you sell on account? So do they have any debtors, right? So by asking these questions, you're trying to work out, what their borrowing needs are. And then once you understand their needs, then you can work out what the solution is, for the borrower.
Yeah, I think you raised some really interesting points. And I know also with that tax debt also comes into it.
Yeah, most definitely. So once you understand what their borrowing need is, then you work out which lender to go to, and asking, do you have tax debt, is a key question, because that's going to knock out the banks, because banks won't look at customers with any tax debt. So then you will have to look at a non-bank or a private lender.
Yeah, indeed. And Matt, from your perspective, what are some of the tips that you'd have in terms of quickly identifying what type of finance an SME would require, and in particular, how that might fit into, say, a private lending camp?
Yeah, look, to touch on Peter's really good points there about asking the right questions. Peter was obviously very comprehensive in the questions that he outlaid there. The most important part of that is, what's the purpose of funding? And I know that sounds like a rather basic question, but you'd be surprised about how many transactions that we get where we don't truly understand what the true purpose of funding is. That's your first place to start, is what do they actually need the money for? As you said, is it a property purchase? Do they have the funds to contribute? If not, where are the funds to contribute coming from? Will that change their statement of position? Will that change their ability to service the debt? More often than not, we get deals where our clients say, yeah, I need money for working capital. Well, what does that look like? Do you know what I mean? It's the age-old line, yeah, I need money for working cap. All right, well, tell me a bit, is your money tied up in debtors and creditors, is what Peter said? Is private lending the right solution? Could you go to a cash flow lender? Could you go to a trade and debtor finance provider who are specialised in that sort of field? A lot of the deals are falling into private lending because, as I said, the bank's appetites are not there, and private lenders obviously don't ask as many questions as the banks. But if you can't cover off what the purpose of true funding is, you're going to struggle to get the deal placed successfully almost anywhere, to be honest.
And I think that's a really interesting point, because I think it's often human nature, and particularly when you're under a time pressure, to look at where to quickly place the deal, opposed to the value of asking multiple questions. And we'll get into this in a moment, and with Shan's overview about really knowing your customer. So really prioritizing that point of that due diligence piece. So before we move over into some of the questions to really understand your customer, Shan, I'll go to you in terms of your perspective from a non-bank place. What do you encourage the brokers that you work with at La Trobe what type of questions do you suggest that they ask?
So questioning is such an important thing, is to understand your customer. So I will get a question which is, can we do this transaction? This is the security. What type of security is it? How big is it? Is it income producing? Is it a standard security? Is it less than 25 acres? Is it commercial? Is it residential? Does it fit? Is it in a building taller than 10 stories? So, and then we'll probably talk to income, to what sort of income can you show, because they're not coming to us because a bank's going to do the deal. So what is their credit history like? Have they had, are they responsible in their banking? Do they make their payments on time? Are they, again, know your customer. So if they're a BAYG customer, they've generally come to us because they won't fit credit score, they won't fit CCR reporting, and they might be a single applicant, which is something that won't fit credit score. So understanding if my broker is across all those levels, all my brokers are quite different. My very experienced brokers will understand that. And then it's my job, or the job of a BDM at any institution, is to educate that broker so that they can have a great transaction with their customer. So then they're self-employed. We want to know, well, how much financial information do you have on that customer? Have they completed financials for 2022? Have they been busy? Is there tax debt? You know, understanding the customer is so important, because if you understand your customer, then you can save yourself time and then lodge the deal with, you know, with policy that you understand and know. So if I was a broker today, I would definitely have 3 to 4 years of full financials of a customer. You know, have there been any changes? Have you defaulted? Have you had a mortgage before? Tell me about you. Tell me. They don't come to a broker generally because someone has said yes to them. They generally come to a broker because they're upset with their bank, who've said no to something basic, because the bank is a data-driven institution that looks at data. They don't understand the actual customer's needs.
Yeah, I think that they're all very valid points. And one thing that I was also just reflecting on, even just in my own experience, is when I've gone to seek funding for my business, my broker has said to me, because, you know, from a business owner, you just want the outcome, right? And the thing that my broker said to me, which I thought was a really smart way to do it, is we're not going to talk about any solutions. All we're going to do is talk about this is a deep dive fact find, and we're not going to have a solution at the end of this. But what I will have is all of the information to then make sure that you're in the best, you're aligned with the most appropriate lender. So I thought that approach was actually really good as well, because particularly in time-sensitive scenarios with business owners, I expect that would transfer over to the broker as well, in terms of feeling that pressure to respond quickly. But I thought his approach sort of flipped that around, saying, you know, I will respond quickly, but what you need to tell me to enable me to do that. And, you know, something that I know, Peter, we've spoken about as well, is just being so upfront. And it's always just so tempting just to, you know, not reference sort of said default or this or that, because, you know, it's something that you don't necessarily think may or may not be important. So I would also encourage, and it's sort of a frustration that I've heard from many lenders, is in, you know, finding the dead bodies, you know, halfway through the settlement process. So being upfront with the dead bodies just enables you to work out which lender is prepared to poke the grave. So moving on from that, so in terms of really understanding your customer, Sian, we'll stay with you because I know that you're a real advocate of this space. And I know you touched briefly on just the types of questions to ask. If we drill down on that a little bit further, can you provide some insights into some specifics that brokers can also just really drill down in their business customers?
So generally a broker will come and say, I need to do an SMSF transaction. How do I do this? So I would say, well, we in our policy and policy for the SIS Act, you would need to look at last 12 months contributions. What's the rental? What's the yield on the security? And they'd go, okay, well, it's not going to fit that. Okay, well, then tell me a bit more about your customer. Have they completed their financials? Have they got their 2 pay slips? Have they set up their bare trust? Have they set up the SMSF instrument? Do they understand the type of instrument they're going into? I probably get asked 3 to 5 times a week, can we do vacant land? So then not giving advice, but gently guiding them back to the trusted advisor that can give that advice. To have those SIS Act conversations is very important. So we're forever, each and every day, educating the customer. If it's a commercial purchase, okay, where are we in the transaction? And generally when they come to La Trobe, they've been elsewhere and they've worked out policy very quickly. And then someone's gone, have you tried La Trobe, because of the loan sizes? And obviously we're a storybook lender. We're a non-bank financial institution that looks at the customer's story and life events. So we want to know the story and we want to put that customer in a better position so we can bring the deal in. I like to say we dry clean the customer so that they can go back to the banks if that's where they choose to go.
Yeah, and I think that notion of a story, like every business has a story, right? It's rarely straightforward with business. So Matt, I might just go to you in terms of that piece as well. Are there any particular questions that you would suggest, and Peter, I'll go to you afterwards as well, that you would really advocate in terms of really understanding that customer?
Look, I really loved the analogy there about the storybook lender, Sian. That's really great. Everyone has a story, and it's just a case of understanding it and being able to articulate it. Being a broker in this market would be incredibly difficult. I know there's a lot of pressure from clients around trying to get the result done and trying to get it done in the quickest time frame. And unfortunately, in private lending, you do see a lot of recycled transactions that are of no fault to the broker. You know, they ask a few questions. As Sash put it, they're poking the grave for the dead bodies and stuff like that. And a lot of clients think, all right, I'm not going to bother with this. I'll go somewhere else and I'll try and get a quicker result, or I'll try and make this easier than it has to be. And that can create a very, the push and pull becomes very hard to deal with. In regards to asking the right questions, I think, as I said, the purpose of funding is incredibly important, but the amount required as a debt solution is also very, very important. Whilst we don't do construction lending, for example, we will cash out clients against other assets to help them build elsewhere. The most important question in that particular instance is this enough to help them do the build? Do they have enough money, inclusive of this debt solution, to actually finalize the build? And the stock standard answer is always, yeah, they do. Well, we're going to have to see evidence of that, because if we cash a client out against another asset and they don't have enough to finish the build and they got nothing else left, what happens after that? They're stuck with an incomplete project. They've got nowhere to go. They can't sell the asset. Not only does it put the lender in a bad position, it also puts the client in a bad position. And the client will turn around and start pointing fingers at ultimately the broker that referred them the transaction. So, when lenders do ask questions, they're not trying to make life difficult. They're not trying to make it hard for you. They're just trying to make sure that everyone's covered, everyone's protected, the broker, the client, the lender. And again, it's all about relationships. It's all about understanding your lender's appetite and your policy, and understanding the transaction as a whole, as opposed to trying to get the quickest and sometimes the cheapest cost solution that you can. It's not always right.
And that's actually a really interesting point. In terms of, and Peter, I'll go to you for your observations about this. In terms of the requirement for funding, and we'll go further into this later, but that rate versus speed of funding, what do you find is a business's priority at the moment?
So back to the point, first of all, you raised a good point. I'd say to clients, we need to go slow to go fast. So I need to ask you these questions, and you need to get through my due diligence first before I take you to the lender, because I don't want to just go, hey, here's a property, and then Matthew asked me 3 questions, and I've got to go back to the client, and it takes a few days, and then those answers to those questions raise another 3 questions, and then by trying to get it in quicker, an application within a day, it takes 2 weeks because we keep digging, as opposed to going, to the client, this is what I found, are there any companies that have been, liquidated in the past, right? It's not saying that we can't lend to them. We just got to take them to a lender that accepts that level of risk and prices, that level of risk to that transaction, as opposed to going, hey, because we're always going to find out once we do the privacies, the company searches, we're going to work that out. So I like to work that out up front. So that's the go slow to go fast. So once I've got everything, I've taken it to the right lender, go, hey, these are all the hairs on it. This is the LVR that we need. What's the price that, represents this level of risk, right? And once we have that, and then we work out what the exit is as well. Is it a 12-month loan, 2-year loan, 3-year loan? And how does the lender ultimately get paid back? Or are they fixing a problem with financials, and financials should be received in the next 6 to 12 months? So then they can be refinanced, maybe from a private back to a non-bank, before, it gets back to a bank, or it just stays in the non-bank space, longer term.
Yeah, and one thing I might, pardon me, bring back to what we were talking about offline as well is, is also really looking at pre-planned investments. So rather than being just in that reactive space when the business sort of needs funding, but to actually sit down, and I don't know whether you do this with accountants as well, but to actually look proactively at those planned investments and when the business might consider that capital injection to then facilitate that?
Yeah, most definitely. And now's a good time that, a new financial year has started to sit down with your clients. And, I mentioned earlier that, the questions that you ask are, what are your planned purchases for the next 12 months? Are you buying residential property? Are you buying a commercial property? Are you looking to, invest in machinery? And then once you know what they're going to buy, is, well, what's that going to be secured against? Now, if it's something specialized, it might not be able to be funded against the asset itself. So then we need to look at property security. If it's a new business, that might not be an opportunity for a bank. So it might have to go to a private lender because it's a brand new entity. Someone, has left their employment, started a business. The business is going well, but they don't have enough of a track record, to be with a bank. So they need to, put some security up. So they're the type of questions, that you ask a client up front, and then knowing how long it takes each lender to process a deal. With a bank, it might be 4 weeks to 3 months. With Latrobe, it might be 6 weeks. With a private lender, it might be 2 to 4 weeks. So saying, well, when you have that planned purchase, we need to ensure that we're 2 months prior to that. We've got the application in, we're instructing valuations in order to meet your deadline, right? Can we get it done urgently? Maybe, but we don't want that stress in 3 months' time. If you're going to buy something, let's have that conversation up front to prevent that stress. And the more time we have, the better deal we can get for the client, because we're not a price taker. We can actually price check against multiple lenders and get the best deal for the client.
Yeah, absolutely. And, again, coming from my personal perspective as a business owner, I've found that discussion in collaboration with both my finance broker and accountant has been really helpful, because obviously the objectives in terms of borrowing money versus tax minimization and this and that and the other is all very, very complex. So I always like to have those planning meetings. I usually do them just myself, like early in the year, just more for the next financial year. So, and just getting into the practice of that as well, it's a really good accountability measure that I also find. So do you encourage brokers to work with accountants in terms of that planning process?
So what I tell clients is you need to have a good accountant, you need to have a good lawyer, you need to have a good finance person. Because if you're transacting, everyone needs to be on the same page. Are my financials up to date? What structure? Who's going to review the contract? How much can I borrow? And the broker, myself, in this situation, I would act as a project manager, ensuring that I get all the information from the relevant parties, because someone needs to drive the process. It's generally not the accountant. It's generally not the lawyer. We're the one engaging with the client, with the lender, with the outgoing mortgagee, with the valuer, with the quantity surveyor, and we're making sure that we're progressing everything, down the line, to ultimately achieve the client's goal, which is, refinance, purchase a property, or whatever they're trying to achieve. So someone needs to, run with that process. And generally, with my clients, I'm the person, directing that traffic.
Yeah, and I think that that's a really important point. I am a massive advocate of the notion of a wealth community. So you've got your dream team around you. So you've got, as you say, your lawyer, accountant, broker, et cetera, because it's also the most efficient way to, not only efficient, but also fail-safe way, because obviously everyone's coming from their different lens. And I know that when I've been doing that from, again, a business perspective, it's definitely a place of security that you're coming from because you are surrounded by the experts. So let's move forward to what we initially just touched on a moment ago in terms of how to lock a customer down and how to sort of flush out those fickle clients who just sort of are shopping around and scattergunning and, perhaps not utilizing the profession's time and resources wisely. And in that process, moving the conversation beyond rate. So Peter, staying with you, how do you go about this in terms of navigating the value that you and your firm brings and the service that you bring, and how to lock that customer into the commitment for that journey?
Okay, so once we've asked all those questions and we understand what the client requires and we understand the security position, then our general process is to contact the lender and tell them the story, and say, this is the story, this is what we're trying to achieve. Can you please provide me high-level terms, which is the rate, the LVR, the fees, anything else associated with the transaction? And then it's the broker's opportunity now to seek formal engagement and issue a mandate or an engagement letter and get the client to commit at this stage, right? This is before putting up an application to the lender, right? So if there is any issue with pricing, if there is any issue with the loan amount, you're going to find out early and not having wasted your own time, the client's time, and the lender's time. So it is an opportunity to nut out any issues that you have up front. So if I issue a mandate, I go, oh, 9.5%, that's too expensive. No problem. Let me see if I can do any better. All right, 9.25, that's the best I can do. Sign the engagement letter, and then we can proceed to a formal application, right? As opposed to doing the application, wasting Matt's time or Sean's time, and then the client goes, oh, 9.5 is too expensive. They didn't take the deal anyway. So now we've wasted all our resources, credits resources, and the client wasn't committed to the transaction anyway. So locking the client down early is the priority.
Okay, and in terms of your methodology, do you have any suggestions of what works for you in that situation?
So once I issue a mandate, with the lender's terms on my letterhead, I get the client to sign that and pay a small commitment fee. It could be $1,000, could be $5,000, depending on the type of transaction, and that's effectively to take the client off the market. Now, if the client's speaking to other brokers, I say to the client, there's no problem. You can speak to lenders, brokers, whoever you want, but you need to make a commitment to one person, whoever you think has demonstrated enough value or can get the job done for you, to proceed with this loan. Because the last thing that, Matt wants is 3 brokers sending him the same deal. What happens in that instance, Matt?
It happens more often than I would like. Look, ordinarily, we would just turn around and say to the 3 brokers individually, send us a mandate, and whoever's got the mandate on the client, we'll proceed accordingly. There have been instances where there's no mandate in play, and certain dynamics of the deal will change, and that gives us a little bit of a concern. Brokers that we know and trust and deal with day in and day out, yeah, absolutely, we're happy to take the mandate and crack on. But new to firm brokers and things like that, are they in control of the client? I'm not sure. We don't issue term sheets for that very reason. We issue letters of offer that are fully credit approved and credit endorsed, and that stops these offers from getting shopped around. Ordinarily, when you get to letter of offer stage, the commitment is already there. But it's a good point you make around commitment fees, Peter. I think as a broker, you shouldn't be afraid to ask for a commitment fee. That's your time as a professional services provider. You've obviously got a lot of experience and a lot of time put into your trade, and to ask for a commitment fee, in my opinion, is completely reasonable.
I know on that note, it's quite a contentious discussion in industry, and I think that you do raise an interesting point, Peter, in terms of just really locking in that customer. Would you expect that the reason people don't charge that commitment fee is they don't want to lose the customer?
Yeah, most definitely. They're scared of losing that customer, but it's better to lose that customer early than lose them late, because if they're not showing commitment to you, they're speaking to multiple people, and no one has demonstrated enough value to that client for them to commit to one person. And that's the issue. And, as soon as I if I have an opportunity, I speak to a lender and they say, we've seen this deal, right? Even at the pricing stage, I'll probably go back to the client and go, I can't help you. It's probably been shopped around too much. And, if another broker couldn't help them at the end, of the cycle, they're beyond help as well. But I get a lot of opportunities where I say no to the client before I even take it to the lender. So, a transaction came to me, 80%, regional pub, and I'm like, too high, not in the current market, refinancing another private lender, it's not happening, right? Unless you come up with another asset worth X amount to cover the shortfall, this is not a transaction. So that transaction, I don't even take to, a lender and ask them for that, because I know that it's not going to happen.
Yeah, and actually staying on that note, and Shan, I'll go to you for this question. What would your tips be, or what would your advice be to brokers to determine whether a deal should go to a lender, obviously coming from your non-bank specialist space?
I guess I will talk about knowing your customer, but further to, brokers dropping deals around, it happens all the time. It happened this morning to me twice. And you'll indicatively make a verbal offer based on XYZ, so valuation and credit assessment. And then, this broker came back and said, oh, but this deal's already with you at this LVR. And so then I just picked up the phone and had a conversation with credit, and the deal's still live in our system. So I picked up the phone again and called the other broker, and I said, look, who's your contact? XYZ. And they said, oh, okay. And I said, well, we're not going to talk further until this transaction's dead, but we're not going to look at it again from another perspective until it's done. So having, I guess, those conversations of asking, have you talked to another broker? Have you talked to another bank? Have you talked to another provider? What was the outcome? I need to know, because again, like Peter said, he doesn't need to be going and talking to someone to hear that it's already there. And at Latrobe, a customer could have 3 or 4 different parties that they've come through. And if it's a little bit left field or the security is a bit different, like this one was, we record it. So we record it in the system. Oh, it's already been shopped. And first broker in is obviously got to finish the transaction. Otherwise, if they're not going to finish it, there's a reason why, and we will tell them why.
Yeah, and I know, Matt, that we've also, similarly to what Shan was saying, is that, in Aquamore, I know that there is definitely a register, even if it's just like not formal, but, which brokers Aquamore does prefer to deal with based on their integrity and their reputation versus other brokers. So I guess what I do want to sort of shine a little bit of a light on is, what are some of the best practice traits you see of brokers, and equally worst practice, more poorer practice traits, and how does that from a lender's perspective affect your receptiveness to the deals?
Yeah, I mean, look, there are unfortunately some brokers that we don't do business with, but the majority of brokers, obviously, we're open to business with anyone, but there are repeat offenders in respect of shopping the deals around and not being completely honest about the transaction. We're very aware of the space that we play in as private lenders. There's a hair on almost every deal. You can't present a deal to me and say it's perfect. It's just a pointless task. I've seen it all before. You may as well, as you said, look, Matt, we have got a transaction here. Here's the problems, but here's the story, and here's why it works, and here's why we think it should work. The banks, as Shan said, are just data centers. They're just, a lot of their RMs and BDMs are just targeted to make X amount of calls and attend X amount of events and make themselves look busy. They've no intention in writing the transaction, but they've got no real accountability in that respect, and that's just the way that it is, and that's fine. But best practice is, here's the transaction. We understand your policy. Yeah, we don't understand your exact appetite. That's why we're having this discussion. Here's the transaction. Here's the problems with it. Can you help us find a solution to it? As Peter mentioned, we often get phone calls from people we've not dealt with, and the first question they ask is, what's your interest rates? Well, how long's a piece of string? We price according to the risk of the transaction, and there could be times when the appetite is strong. There could be times when the market's a bit down and appetite is a little bit more reduced. And I guess my advice is just keep in touch with your good lenders. Keep in touch with them about what their appetite is. Don't be afraid to pick up the phone and have a discussion, but on that basis, you do have to understand the deal, and you do have to understand that it's not all about who's the cheapest rate, because if it's the cheapest interest rate, then spend 10 weeks with NAB or ANZ or whoever and try and get it done. If you want a solution, then look elsewhere, and as I said, just be as honest and upfront about the transaction as you possibly can.
No, I agree. And I think on that note, one thing I would also caution everyone who's listening is to make sure that you're really comparing apples for apples with rates in terms of really understanding what you're committing to, and that a headline rate may or may not be the actual rate of which, you know, your finance brokers will guide you through. I guess also the other consideration with that is, you know, coming from a business perspective, going from a mortgage or being a residential borrower to then a business borrower, again, as a business, can be quite a daunting reality shock, because suddenly, you know, you're talking like potentially substantially different rates and terms and so on and so forth. So I think particularly that education piece of the business's maturity to understand debt solutions is really important. And I would expect that it will also be a much smoother conversation to match, you know, your understanding of their debt maturity with the solutions or the process that you're recommending. So we might move on, and just in terms of then determining, again, that hypothetical deal from a real deal. Peter, we'll go back to you. What's your recommendation for working out the real deal versus one which is more fictitious or perhaps more fanciful?
Yeah, so try to work out if it's a real deal or not. I think Matt mentioned if when they ask, how much can I borrow? You know, just having a general, you know, question like that, you know, how long's a piece of string? So you've got to understand the purpose. So if they don't understand the purpose, you know, then you're playing with hypothetical scenarios, right? We don't get paid, you know, to settle hypothetical loans. So having an understanding, you know, of what the client actually needs the funds for will determine whether or not it's a hypothetical scenario. I had a client come to me, wanted to buy a pub, you know, up in Queensland, you know, maybe a $6 million pub. How much can I borrow? And I'm like, I don't know. Here's my mandate. I've got some indicative pricing. Do you want to proceed? And he's like, well, that's too expensive. You know, can you give me the loan? And I'm like, well, this takes a lot of work. You know, I don't want to waste the lender's time. Do you have enough equity, you know, minimum 30% in that transaction, right? That, you know, either property security or cash. Otherwise, we're hypothetical. A lot of brokers will see a $6 million transaction and spend a lot of time on it, hoping, you know, that all the stars are going to align and it's going to come off. And, you know, a client said to me, I don't pay any upfront fees. And I said to him, no problem. Happy to be friends. You know, we can have a coffee whenever you want, but unfortunately, you don't have to be my client, right? I'm just going to focus my time on clients that value, you know, my time and my service. And, you know, I'll be working directly with them. And, you know, I've probably saved myself 80 hours, you know, and he didn't buy anything in the end anyway, you know. So it's having an understanding, you know, of the client, and, you know, it might come back to their character, and then, you know, are they just like talking to people, trying to big note themselves like they're trying to do a deal, or you know, they've actually got some substance. So yeah, understanding the borrowing purpose to start with is one way to get rid of tire kickers. If they don't know what they want, there's no chance you can sell that, you know, to a lender.
And do you find that just proportionately that is the case often? In like a businesses, in terms of just being opportunistic without understanding the implications, do you find that that happens more often than not, or are businesses genuinely seeking funds for a particular purpose?
So it all depends where your business comes from. So if you do like a Google AdWords or some sort of Facebook marketing campaign, well, then you're going to get random people that don't know what you do. They just need money and a lot of time wasters. But if you're working with your network, accountants, lawyers that understand your value proposition and what you can provide, that tends to be, you know, less often than not, right? I might get a couple of those a year. But when I did do a marketing campaign on Facebook, I was speaking to people that, you know, weren't credit worthy, just wanted to get as much money as they could, didn't understand security, you know. So it all depends where your business comes from, you know, and that's that quality over quantity proposition. So if your market is just, machine gun, let's see where it hits, well, you get a lot of these, tie kickers and time wasters, just hoping for the best, right? Oh, I've got a business I want to start with no experience. I need $5 million.
Right.
Right.
Yeah, I think you raised such an important point. And being a marketer and providing brokers counsel through the lenders that we work with, I absolutely echo your sentiment. I would be very strongly against brokers doing general advertising of any description, whether it's Facebook or Google AdWords or so on and so forth. A, because you can spend a whole load of money on it, and B, the quality of that lead, even though you get a lot of eyes and perhaps engagement, where is the quality coming from? So I would echo your sentiment completely, Peter. I strongly urge the brokers listening to really utilize their referral networks, particularly accountants and other professional services, to really make sure that the quality of that client and the genuine requirement of that client is there, and also the commitment of that client. Because I would expect that if, particularly say, an accountant refers you a client, there's already an established need for a type of finance. So that's my just 2 cents worth, because I can't help it from a marketing perspective. Yeah. Matt, how about you? What are your observations?
Yeah, look, the shotgun approach, or the machine gun approach, as Peter said it, generally, in my opinion, doesn't work. More often than not, it's a lazy approach to trying to get things done. And if we see the same deal 3, 4, 5, 6 times, I could give you countless examples of deals that are still floating around the market now. Probably half the people on this call might have seen them, but it's lazy to an extent because you don't want to take the time to understand your lender's policy. And if that happens, more often than not, we'll just kill the transaction, and that hurts everyone, hurts the client, hurts you. I think there's an uneven bargaining power with clients and brokers at the moment. There's 20,000 registered brokers in Australia, very competitive marketplace. The best brokers that I know, they don't advertise yet. They don't advertise on the side of buses, or, I mean, residential lending aside, your Mortgage Choice and Smartline and local brokers that look after regional towns, that sort of thing, they're probably exempt from this. But the good brokers that I know do very little advertising. It's all word of mouth, repeat referrals, very strong, experienced people who know what they're doing, and they take away that bargaining power from the clients, who think, well, I'm not paying a commitment fee, as Peter said, I'll go somewhere else. What happens to the next person? Yep, I'll go somewhere else, I'll go somewhere else. And for me, yeah, that bargaining power is a bit skewed in favour of the client. And I think it's important that gets leveraged in a little bit, so that broker, as I said earlier, brokers have got a very hard job, and they don't need difficult clients making that harder. So yeah, there's my 2 cents on it.
No, I agree. And, also the power of your database is gold, right? Mm. And particularly at the moment, where there is such a shift and such a spotlight on alternative finance, commercial lending, and so on and so forth, I always say to brokers that to look at your database and just determine who's pay to go and who is not. And then if you're not familiar with the space, to either upskill, whether that's through CAFA or any of those other great commercial finance institutes, or to collaborate with a commercial finance specialist such as Peter whilst you're learning the ropes. One thing when I did want to also raise that came to mind when we're talking about, I think, Shan, when you mentioned SMSF lending, to make sure you really own your space. So SMSF lending particularly is so complex. Again, if you've got an SMSF client, if you don't know the space, to align with a broker who does, or speak to Shan or another lender who does specialize in it, just to make sure that you are asking the right questions, particularly in such a complex space. So Shan, I've referenced you, I might stay with you. In terms of expediting a decision for funding from a non-bank's perspective, what is the best case? What is the best practice scenario? What type of parameters or due diligence is presented to you to expedite that loan as quickly as possible?
Generally, when we start the conversation, it's quite limited, again, depending on the level of experience. My most experienced brokers know our policy inside and out, and they tell the customer we're going to La Trobe because I know we'll get a solution. They fully package the deal up with an application or the checklist that we need. And then pretty much we can have the approval in 10 business days if it's fully packaged and in the right channel. And if you're in our Premier team, that's where you'll sit and you get that, that PP treatment. So keeping the customer updated. And as I think Peter mentioned earlier, there's no point coming 2 weeks before settlement's due and then putting pressure on everyone, because it's just like a big cooker. It's like manage your customer's expectation, be prepared. And if you're not, have those great relationships, like Matt said, where you can call your lender and say, look, this is what we've got. And I'd say, well, firstly, we can't do it in 5 business days. Go and maybe talk to Matt and the team at Aquamore, settle it privately, and then do it in a proper manner. So, once we get to approval and docs out, we pretty much will settle very quickly, as long as, again, the broker reads the documents that are sent to the customer, shows them where to sign, returns the correct insurances, and then they're good to go. And I think something else was mentioned as well about talking to your customer as well, like on your touch points. So don't just make it a transaction, if it's their first time, drop them off a dinner set. You're getting paid for the deal. After 3 months, how's it all going? Rates have been increasing, checking in on them. You've seen their servicing, you've seen their living expenses, you've seen, they might have 6 children. Check in on the personalized stuff, make your customer personalized, so that, when it gets to 3, 6, 9 months, it doesn't matter if, like you said, Sasha, you might be at a barbecue and some really nice brokers like, oh, what do you do? And, and it always leads to somewhere generally leads to, a need. And you'd be able to say, well, actually, no, I've got Peter as my broker and he's my go-to, my trusted advisor. So it doesn't matter if your customer sits in any sort of social manner, a good broker is going to lead that conversation to, well, I can help you and make it personalized. So I always think back to know your client, understand your customer, and show your appreciation when you have done the transaction. It's so important.
Yeah, and I think that you raise a super important point. And again, just to hijack the conversation and put it into marketing world again for a minute, the big thing in marketing at the moment is personalization, in terms of how that really escalates trust and retention. And I think it is a traditional model more in the resi space, but I haven't personally witnessed it so much in the commercial space. So I think that there is tremendous opportunity. And as you say, just like a little nominal gift or other, just to recognize. And I think, the true appreciation from a borrower's perspective is that you've been seen and heard, and you've been on that journey. And I think you're right, it does definitely breed loyalty. And the other thing I want to just really acknowledge of what you were saying as well, Shan, is just that check-in. Like my broker will call me every couple of months, and he's clearly made some notes about what's going on with business and this and that and the other. And then he'll be like, how's your doc? So just those check-ins also just means that I'm thinking front of mind as a business owner, what are my next steps, and am I on track, and does that match my forecasting, and so on and so forth. So I think I think in marketing, people often look for where the silver bullet is, but I think to your point, if you can make it personalized and if you can make it just authentic, then you've got these really fantastic, loyal, sticky clients that then are your champions and refer you more business. So Matt, I will go to you. So in terms of expediting funding, what do you often notice? Do you notice any trends in terms of roadblocks? Like, a deal getting to a particular point and then stalling in the private lending space?
Yeah, big time. I think the end-to-end process is, as a broker, is important that you've got that network around you. Shannon, Peter both alluded to that point, that the broker is they're directing the conversation, they're directing the way that things are going. They need to have good connections, good conveyancers, good lawyers, good solicitors to help your client out. Being the broker is only just one part of it. What we see a lot of is, for example, brokers get really caught up in the excitement of finding themselves a deal, and they've been able to engage the client and they've got over the hard bit. Then they just send you a bunch of documents, sometimes more often than not without even looking at them, and that looks like unsigned application forms, for example, out of date identification, an accountant's declaration, for example, that's got $0 declared as income. And once that gets sent to the lender, depending on your relationship, the lender can't unsee that. So my advice would be just take a little bit of time, just be very careful with the information that you're sending to the lender. Again, if you've got a strong relationship with your lender, then okay, that's fine. Look, sorry, I didn't know the form was unsigned, or I didn't check the accountant's deck before I sent you it. But if this is a new relationship with a new lender, you could burn that bridge very quickly if you don't take the time, and I'm talking 5 minutes, just to double check what the client sent you. More often than not, it's a mistake, it's a typo. Client hasn't signed in the right place. Hey, Mr. Client, Mr. or Mrs. Client, can you please re-sign this? And that would all be avoided. Again, I think there's this bargaining power that if you ask the client for information or ask them for a form or this or that you're inconveniencing them and you're making it too hard. And that's not the way that it should be, because ultimately everybody's got the same goal. So just slow down a little bit, take that 5 or 10 minutes to make sure that everything's in place. And a question that I would ask is, would I put my own money into this transaction? Is there something that doesn't make sense? Try and make it make sense. I mean, there's a lot of times we'll get a decline deal and the broker will, jump up and down and say, look, I've got this and I can get that, and I understand that this has happened. Address all of that up front. If you address all that up front, it makes it so much easier. And that takes 5 or 10 minutes. So yeah, just take your time and engage with people correctly.
Good advice. And Shan, from your perspective, is there any point that you see a deal starting to sort of bottleneck or fall over?
As Matt said, knowing your customer, recent example being commercial property, bringing it out from the bank, young broker didn't know what a GSA was. So we educated her very quickly, and we got another transaction out of the same customer, and she definitely knows what a GSA is. It's a stitch up from the bank to keep all their securities there. And, she was young, and, I didn't think to ask her the GSA. I was asked to look at a commercial transaction. So she will forever know what a GSA is. So again, ask those questions. If they're with a bank, do they have any GSAs on you? Sometimes they don't know, and they can get it just from a car.
Yeah,
not even from a house. So, knowing what have you got where, and, tell me a bit about this. Tell me all about this.
Yeah, indeed. And Peter, finally with you, any sort of classic bottlenecks or where things fall over?
Well, once they're mandated, my conversion rate's probably like 90%, right? So I let them fall over very, very early.
Yeah.
But on that GSA point, $2 from PPSR, you can get a search, and you can tell the client, what are all these 15 loans that you have and 6 GSAs already? And, so that for $2, you're going to save a lot of time, up front. So, that's just a little tip. And then you got to work with the other lenders if you're actually going to do the deal to get the GSAs released as well. And that's an issue. So, but yeah, in terms of, expediting a deal is like knowing the lenders, having all the information up front, making sure everyone's clear on rate, LVR, terms, fees, all that's up front, being mandated, and then that's when the deals go through, right? Everyone needs to be committed to the process. And, what I say is the client needs the money, not me, right? So they need to be part of the process. If you're dragging the client to the lender, they're not motivated. So, they ultimately need to be motivated. And if there's a clear deadline, obviously that helps expedite the transaction, a settlement date, or a expiry of an existing facility that gets you there. Otherwise, they can linger for a long time as well. So,
yeah.
Good advice. Well, thank you so much for your insights today. And also you did a wonderful job just answering all of the questions from today's event just live. So I hope everyone found this webinar insightful. Matt, thank you for joining us.
Thanks, Sasha. Thanks for your time. Thanks, guys.
Shan, pleasure to have you.
No, thank you, Sasha. And thank you, Matt and Peter. And to those listening, good luck. Ask those important questions and know your customer.
And Peter, thank you for your on the ground
thank you.
insights. You're all fantastic. Have a good rest of your day.
Thanks a lot.